Okay, so we talked about subsequent expenditure. The rule which we keep in mind is that you need to, as a manager, you need to think that this expenditure which I'm spending it on the asset, is it material or not? Number one. And number two, what do we do with that? Is it going to enhance my, how to say, capacity or not? And by the way, there are sometimes some exceptions which as a manager you will take. I give you some example. One example I will take, not a lot. In fact, two, three I will give you, by the way, I'm sorry. One from my personal experience and one from some other colleague. I remember that in 2014 or 15, in my office, we had a cabled network. Somehow we never were in favor of, because of security reasons, we never believed in wireless or Wi-Fi. So we had cable network. So we had this office on this floor, and then we purchased or rented another office on some other floor. So they were in between, there were two floors differences. So we had to put a cable network here, and we decided to change the cable network here as well. And we connected that thing. And we spent something like, if I'm not mistaken, back at that time, something like $8,000 or $9,000 on cables. What do I do with this $9,000 cable? Remember, for asset, when you make some expenditure on an asset and you make it on a property, which is a leased property, the life of that asset cannot be more than the life of the lease. Let's suppose my lease contract for 3 years. And let's suppose that cables, they have a life of 5 years. But because you, you have a leased contract for only 3 years about this rental agreement, you should be making the life also 3 years at the max. Because after 3 years, you cannot use this property or you cannot use this asset. One thing you should remember about the life of the asset.
So what if the lease having a renewable clause?
Yeah, now I will come back. Yeah, if it is a automatic renewable, you can extend. Now, the question here is, in my case, I did not take it to CapEx. I put all of 1,000, all of this 8,000 into OpEx. That was my judgment. Maybe somebody else would disagree with that, but based on my understanding, based on my, how to say, style of accounting, I took all of this 8,000 as OpEx into my P&L within 1 year. Because my belief is that these are the cables. If in any case I have to take them out, they are of zero value. Your computers, you can transport from one place to another place, but cables you cannot. Cables, once you lay down, they are there, they are gone. And for me, take them in 3 years and 8,000 depreciating over 3 years, it's a small amount as compared to my profitability. For me, 8,000 is immaterial. And to keep my books clean, I also do not want, because once you make something as a non-current asset, you have to take it to your asset register. You have to keep a record of that. And therefore, we call it small value assets, okay? Small value assets. Small value assets, many times, you charge them to the P&L, although they do have a life longer than 1 year. Like you are purchasing a keyboard. You might be using a keyboard for 3 years. You are purchasing a wall clock. You might be using a wall clock for 5 years. Wall clock is for $50. Are you going to capitalize it and then start depreciating it in your asset register? Answer is no. Take them to P&L, small value assets, or some other situation. So in many cases, because IFRS gives you judgment. Remember, what is going to be the life of asset? You have to decide. IFRS does not tell you, because once you acquire the asset and you determine the cost, that cost of my asset is, I don't know, 500,000. How about the life of the asset? Now, life is an estimate. IFRS does not tell you. This is a fact, okay? 500,000 is a fact, but this life is going to be an estimate. So you decide how much is the life. And here you talk about the industry standards. Industry standard means that normally what is assumed, normally what is presumed, normally how it is treated. Like if you talk about vehicles, take 5 years. It is a common understanding. If you talk about furniture, take it 5 years. If you talk about computers, take it 3 years. If you talk about heavy vehicles, take them to 7 to 10 years. If you talk about plant and machinery, now plant and machinery could be complex because car, furniture, computer, I know, you know, everybody knows. But you see some piece of equipment, you don't know how many years it will work. In that case, you should take it from the supplier. The supplier, the manufacturer, they knows that for how many years it can be used. And then based on them, you take their, I mean, the manual, you have it with you. The manual, the supplier, they tell you that this asset is for 5 years. I give you an example. I took a water pump for 55,000 euros. 55,000 euros, I purchased a very powerful water jet. The supplier said it is for 5 years. But after using 1 year, we knew that it cannot work for 5 years. We decreased the life for 3 years. You always have an option to decrease the life because it was your internal estimate. So once you buy an asset, you decide the life. After spending some time, you may decide to change the life. And when you change the life, you also change the depreciation. And then you have to decide the residual value of the asset. Okay, so the asset is for 50,000 or 500,000. What is the residual value? Which means that at the end of 5 years, how much would be the value of this asset? Again, that is your own internal estimate. And you don't think about numbers, like don't say 50,000 or 100,000. You think about percentages. You say that after 5 years, the asset will remain 20% of its life. And then if you have 500,000, 20% means 100,000. So this is 100,000 would be the remaining value at the end of the years. So if I purchase asset for 500K now, and I believe to use it for 5 years, and then I think that after 5 years, it will remain 100,000. So I subtract this thing, 400,000 is the amount which I need to depreciate. You call it depreciable amount. So 400,000 you are going to depreciate over a life of 5 years, either using reducing balance. In reducing balance, you don't subtract, by the way. When you subtract, you are typically going for straight line method. If you want to do reducing balance, then reducing balance would be something like 500,000 straight into 25%, let's suppose. In reducing balance, you do not subtract the residual value. In straight line method, you say 400,000 and divide it by 5, and you say, okay, I'm going to charge 40K depreciation every year. So IFRS does not tell you about the residual value. It does not tell you about the life of the asset. These things you have to decide as part of your accounting policy based on the industry standards. Then you have sometimes complex assets. Complex assets are huge value assets, and you need to split them. You need to split them into different portions to calculate the proper depreciation. For example, you have a building, okay? So that building, the total worth of that building is 20 million. Now, it is not one component. It is a complex asset because it has land. Land is, say, 3 million. It has structure, which is, say, 5 million. It has facade opening, which has, say, 3 million. It has internal finishing, which is 7 million. It has electric HVE, you call it heating and ventilation system, which is, I don't know, 3 million. All of these things have different life. Land is never depreciated. So land is no depreciation. Structure might be for 40 years. External facade may be for 10 years. Internal fittings may be for 10 years. Electric heating ventilation may be for 7 years. So you need to split the asset into different components and then start calculating depreciation. You cannot say that entire 20 million, let's depreciate it over 40 years, because not everybody will live for 40 years. You cannot expect that your heating or your ventilation system has a life of 40 years. The same goes for aeroplanes, okay? You have an aeroplane. Aeroplane is 150 million. A Boeing is, Airbus is 150 million of value. But on that aeroplane, you've got the body, you've got the engine, and you've got the internal fittings or finishing, whatever you call it. Body, out of 150 million, 40 million is for engine. Body probably is another 60 million, and internal fittings are for 50 million, and systems and software. Now, aeroplane, we say generally is 20 years life, but not everything has 20 years life, because body will have a 20 years life. So 60 million should be depreciated over 20 years, but internal fittings might be having over 7 years life. Engine might be having only 10 years life. So we call them complex assets. So complex assets need to be separated. Just like Muhammad was saying that we have major overhaul. So let's suppose that you purchase an asset. I'm giving now example to Muhammad, okay? What you were saying. You purchase an asset for 10 million. And you know that life of the asset is, let's suppose, 10 years. But then you have some major component of 2 million, which has a life of only 4 years. So which means that within this 10 million, there is a component which is 2 million, which has only 4 years life. So what I need to do, 10 million over it, 8 million over 10 years depreciation, and this 2 million should be depreciated over 4 years according to the life. And then 8 million divided by 10 years makes me 0.8. 2 million divided by 4 makes me 0.5. And I would say that my annual depreciation would be 1.3 million. So this is how you should be splitting the complex assets. And you would be definitely in exam, it is a very common topic to give you a complex asset where you split, because in real life, it does happen. You can't just take an aeroplane, 150 million divided by 40, a building, 20 million divided by 20 or so on. Does not happen. You need to split. We call it complex asset, which are made up of separate components. Subsequent expenditures, furnace, aircraft, I already have given you. Example, airframe, depreciate over 20 years, seating, depreciate over 8 years, engines over 6 years, whatever is the suitable life. IFRS will not tell you this 28 or 6, because you have to see what is the asset, what is the industry. Maybe there are some long life planes, there are some short life planes, there are some expensive planes, there are some cheaper planes, etc. But what you need to remember, that you have different classes of assets. Okay? One class of asset is called land and building. One class of asset is called plant and machinery. One class of asset is called motor vehicles. And IFRS allows you to choose a different accounting policy for a different class of asset. For example, I have motor vehicle, I have buildings, I have machinery, plant and machinery. And IFRS gives me two methods, straight line method and reducing balance method, okay? So I can choose that motor vehicles will be on reducing balance. Land and building, land of course not, building should be on my straight line method, and machinery should be on reducing balance method. It is possible that different classes of assets, you apply a different accounting method. But you should remember that once you choose motor vehicle for reducing balance, then all of the motor vehicles will be reducing balance. Once you say that buildings have to be straight line, then you say all of the buildings have to be straight line. Now, IFRS gives you two methods and say, pick up this one or pick up that one. If there is only one method, then I don't need to think, because there is only one method, I have to apply the same. But when there are two methods and I have to make a choice, then my choice should have some logic. My choice should have some rationale, because I will come and I will ask you that Rajesh, why did you choose reducing balance method for motor vehicles? And why do you choose straight line method for building? You are picking up two different things, two different methods. There must be something going on in your mind. What was the reason? The reason is, you should remember that all those assets where the revenue, where the economic benefit is decreasing as the asset is becoming old. Because you should remember that straight line method, it charges equal depreciation throughout every year. It charges equal depreciation. But reducing balance method, reducing balance method, it takes more depreciation in the initial years and less depreciation in the last years. So if you see that an asset is giving benefit more in the initial years and less in the later years, then reducing balance method you should take, so that more benefit and more depreciation in the beginning years and less benefit and less depreciation in the later years. But if you see some assets where the benefits is straightforward, the benefit is not decreasing. Benefit does not depend if the asset is getting older or not. Like buildings, you give a building on rent, the rents are stable. Rents are not going down as the building is getting old. In that case, straight line method, like your furniture, straight line method, because furniture you use in your office and your customers, they come in and they don't say that, oh, your table is getting old, I will give you less money. So furniture does not impact your revenue generation capacity. It is giving the same. So better to do it straight line method. But your plant and machinery, as your machinery is becoming old, its output is going down, the technology is getting old, and the old technology, you are selling product at a lower price, maybe output is same, but the unit price will go down, or maybe the cost of maintenance has gone up, so benefit is going down. So machinery, generally we take reducing balance. Motor vehicles, generally we take reducing balance. Building straight line, furniture straight line. But I told you, I explained you the logic behind these two methods. So you then start depreciating them. We say that where the subsequent expenditure does not meet the asset recognition criteria, the recognition criteria is that if the subsequent expenditure is increasing the revenue generation capacity or not, if it is increasing the benefit or not. If it is not increasing the benefit, then recognize as expense. Expense means operating expense, take it to the income statement. Double entry is debit, repair and maintenance expense, credit cash or bank. If you want, then debit non-current asset, credit cash. Then comes the next topic, which is measurement after recognition.